The Intelligent Investor, the definitive book on value investing. Benjamin Graham, Harper Business, 2006. Many useful tips to invest successfully and discover that you don't need a stratospheric IQ. What you need is an intellectual attitude that helps you make decisions and the ability to manage your emotions. Learn the difference between being an active or passive investor and choosing the most appropriate behavior for your preferences. Discover the recipe for financial success. Learn to become a critical thinker, trust facts, invest with patience, discipline, and courage. The author, Benjamin Graham, London, May 9th, 1894, Aix-en-Provence, September 21st, 1976, is considered the father of value investing. His innovative ideas have been the basis of his work as a university professor and as an entrepreneur. The Intelligent Investor, 1949, is still considered one of the most important financial investment techniques and is periodically republished with changes that adapt it to modern times. What do intelligent speculators and investors do? Investment and speculation must be kept totally separate, both in your mind and in your portfolio. Just as intelligent investment exists, so does intelligent speculation. It's a matter of choice. What is absolutely wrong is misunderstanding. To think that you are investing when you are speculating instead. The intelligent speculator must work by looking forward, anticipating market trends. He must do the opposite of the intelligent investor, who instead bases his analyses on what does not fluctuate, on what remains constant over time. For this, it is necessary to have a satisfactory knowledge of the background of the stock market in which you want to operate. However, to protect yourself against losses that can be catastrophic, you should never devote more than 10% of your funds to speculation. The intelligent investor and inflation. The intelligent investor worries about inflation and watches over the market to protect himself from the unexpected. It is essential to keep in mind that there is never a perfect time to be in one asset. The diversification of a portfolio is strategic. What are the characteristics of a defensive investor? The defensive investor is one who does not have the time or the will to make the necessary efforts to be an enterprising investor. He works with a passive approach. He will seek conservative investments that require minimal effort in terms of portfolio management, research, and selection of individual investments. Unlike the enterprising investor, he will not expand his potential beyond conservative and stable choices. The amount of risk one should accept depends on the amount of intelligent effort one is willing and able to spend, and one must be prepared to accept an average return. The defensive investor can divide his portfolio equally between stocks and bonds. The rebalancing of the portfolio can be rethought at times when valuations significantly indicate the convenience of a different allocation of assets in relation to the target of 50-50. The two main advantages of stocks are protection from inflation and a higher rate of return than long-term bonds. These advantages can be wasted if the investor pays too high a price for their shares. These are the characteristics that must guide the defensive investor in the creation of their portfolio. Adequate diversification from 10 to 30 companies. Large companies and sound financial conditions. Dividends, 20 consecutive years of dividend payment and growing earnings. Limit the purchase price you are willing to pay. Moderate price/earnings ratio. The share price must not exceed more than 15 times the average earnings of the last 3 years. Moderate price/book value ratio. The share price must not exceed 1.5 times the book value of the assets. Especially if they are inexperienced, the intelligent investor never tries to beat the market, but focuses on understanding the difference between price and value. In the long run, knowledge, discipline, and the ability to pay reasonable prices will make the difference. The defensive investor can choose to invest in investment funds. These investment vehicles provide a convenient means of saving and investing, from which to expect average returns. The advantage of acting through an investment fund is to diversify your portfolio in a cost-effective way and with a little effort. Who is the enterprising investor and what is their strategy? The enterprising investor has the time and experience, or has an adequate guide, in investing, which allows him to expand the possible scope of opportunities beyond the conservative sphere. He works with an active approach, which requires constant attention and monitoring. The enterprising investor is willing to make the necessary efforts required for dynamic portfolio management, research, and selection of individual investments. Greater profits can be obtained from the enterprising investor in exchange for his dedication to these activities. In general, the enterprising investor must not invest in low-rated bonds, invest in new issues, invest in stocks with little history, especially if they are foreign. The goal of the enterprising investor is to obtain an above-average yield rate. To achieve this, he will have to carry out 4 activities. Buy when the market is low and sell when it is rising. Tactical asset allocation. Buy rising stocks. Buy below the market value, bargain purchase, such as, for example, the case of an established company that has a price per share lower than the historical average price. Buy special deals. One must be able to identify particular situations, such as, for example, the case of a small company that is about to be acquired by a very large one. There is no middle ground between the defensive and the enterprising investor. If you are unwilling to devote the time and energy you need to your portfolio, you better choose to be defensive. For the enterprising investor, success comes by honing the ability to understand which stocks are underestimated, that is, those that have a market price that does not fully reflect their value. For this analysis, the indicators to follow are robust financial conditions, earning stability, positive in the last 5 years, current dividend payment, current earnings higher than those of the previous year. How should an intelligent investor behave towards fluctuations? Market fluctuations can be wild. The investor runs the risk of not being focused on the value of the shares in the way that an entrepreneur has to be, but rather allowing his emotions to determine his approach when it comes to deciding whether to sell or buy. Many devote their attention to indicators that, they believe, can predict the future. But it is absurd to think that common investors can make money with market forecasts. The intelligent investor uses prices as a parameter to make buying and selling decisions. He buys stocks when they are priced below their fair value and sells stocks when they exceed the fair value. Mr. Market, the parable of value investing. Imagine that you have a partner called Mr. Market who offers you a different price every day at which you can buy his shares in the company or sell yours. The intelligent investor has done his homework and knows the intrinsic value of the company's shares. When Mr. Market wants to sell his shares at prices below intrinsic value, the intelligent investor chooses to buy. When Mr. Market is willing to buy shares at a price above their fundamental value, the intelligent investor sells. This is the discipline to follow. As an intelligent investor, you are only doing business when this business is to your advantage, and this is everything. The intelligent investor must be able, financially and emotionally, to benefit from prices disconnected from their real value. It is important to be prepared for the inevitable market fluctuations, to avoid owning securities that are priced higher than their real value, to be aware of excessive exchanges and irregular fluctuations in performance. Intelligent investors and advisors. A lot of bad advice is given for free. The advisor's most important goal should be to save the investor from his worst enemy, himself. A good consultant will help keep emotions in check, especially during important moments. Instead of panicking, the well-advised intelligent investor will be ready to buy when prices have gone down. Instead of following the crowd, who could buy at prices far above intrinsic value, they will be able to wait and look for better deals elsewhere. Why is the intelligent investor lay? When choosing the investment, the investor must be lay. This means that the analysis of past performances must guide him in his judgments. There is no room for emotions. There is no room for conjectures. The greater the quantity of hypotheses that must be made about the future, the greater the possibility of making an assessment error. In bond analysis, the most reliable benchmark for security is the profit coverage test. How many times and based on how much the company's earnings covered expenses for a considerable period of time, at least 7 years. In the analysis of common shares, the company's valuation is compared with the current price to determine whether the purchase is inviting. Obviously, an investor should look for a safety margin. In other words, buy at a lower figure than the real value. Average future earnings should be the main indicator when considering value. However, the selection of investments should also take into account the required yield rate, capitalization rate. The smart investor must be steadfast in his refusal to give importance to short-term earnings. The more an analysis is based on them, the higher the risk, the more attention and caution is needed. The most reliable indicator of the company's future health is medium-term earnings, 7/10 years. How to evaluate convertible bonds. The buyer of convertible bonds usually waives the return and accepts more risk in exchange for the conversion privilege. However, the company could go against the benefits of common shareholders for the benefits of its future growth. The truth is that convertible bonds need to be assessed individually on a case-by-case basis. Shareholders must have an active role in the company. Shareholders are called to take an active role, to feel that they are owners of the company. The management that gives good results must be rewarded, while the one that produces poor results should be questioned and contested. The intelligent investor holds the members of the board of directors accountable. Their management decisions, dividend policies, repurchase programs, and the general commitment to pursuing the interests of the shareholders must therefore be analyzed and taken into consideration as key factors in assessing the quality of the investment. The margin of safety. These are the three most important words. The margin of safety is also referred to as the solid investment secret and the central investment concept. What is it? The safety margin for an investment is the difference between the real value of the share and the purchase price. The goal of the intelligent investor is to pay less for the stocks, hopefully much less than its real value. The greater the gap between the two values, the greater the margin of discretion that allows you to absorb the effects of negative conditions before they turn into a loss of money. If the conditions are as good as expected or even better, the profits are exponentially higher based on how large the starting margin is. Virtually anyone with a little knowledge and very hard work can analyze the past. The importance of this exercise is clear, since not even the best analysts are able to predict the future in a consistent and accurate way. The margin of safety function serves to make these predictions unnecessary. In other words, having a security buffer allows you to invest even on the basis of inaccurate forecasts. What is the right purchase price to pay? As already mentioned, the margin of safety is a function completely dependent on the price paid. Each bond has a price that guarantees a margin of safety that makes one inclined to purchase it. The key point of intelligent investment is knowing how to determine what this purchase price is and having the discipline to invest only at a price equal to or lower than it. This is where the main difficulty lies. It is essential to be able to resist the temptation and risk of paying too high a price for a good quality investment. You have to be very careful. It is easy to draw wrong conclusions if you rely on the profitability of a company due to some good years. A true safety margin requires sufficient time. The purchase of growth stocks is not recommended. Analysts tend to project the future earnings of growth companies at far above average rates, leaving little room for errors or changes in conditions. Growing stocks should only be purchased when the price provides a margin of safety based on conservative projections. The intelligent investor diversifies. Diversification is a fundamental part of intelligent investment, and it is through this that the margin of safety is built for the portfolio as a whole. We've turned the odds in our favor by making sure that every single investment has a margin of safety. However, regardless of how well we have done this, some of our investments will fail to meet expectations. Adding the criterion of diversification means placing yourself in the condition of having combined earnings that will be much higher than any losses. The more opportunities we create that are to meet our safety requirements, the more likely it is that our portfolio as a whole will produce above average profits. Quotes: "A great company is not a great investment if you pay too much for the stock. If you focus on owning solid shares acquired at reasonable prices, the results will take care of themselves. Never buy a stock because it has gone up, or sell one because it has gone down. The best way to measure your investing success is not by whether you're beating the market, but by whether you've put in place a financial plan and a behavioral discipline that are likely to get you where you want to go. Losing some money is an inevitable part of investing, and there's nothing you can do to prevent it. But to be an intelligent investor, you must take responsibility for ensuring that you never lose most or all of your money. Successful investing is about managing risk, not avoiding it." Take-home message: deciding on your investor attitude is essential. In the same way, speculation must be clearly distinguished from investment. Never try to beat the market and never get carried away by emotions. Each investor, with a little serious work, can analyze the past and draw key information from it for his activities. Not even the best analysts are able to completely predict the future, but having a margin of safety makes the forecast superfluous and allows you to operate with a good margin of maneuver even when market conditions are not optimal.